Good morning, everybody. It is Friday, October 29th, 2 days to Halloween. Very scary. And these markets, they should be making you think again. And we're going to look at earnings today. I'm going to give you a rundown of what that means about inflation and think about what comes next. Last week, I wrote this story, earnings rundown and quarterly updates. Went through a few things, decided to tease this guy. I tried to republish this article to the free side of Seeking Alpha, and I was told that I can't disparage corporate CEOs. I think that's bullshit, especially with people like this guy. I'm going to rewrite the article just to focus on Facebook, and I'll take a couple shots at Zuckerberg on there. But apparently, this is what got me in trouble. He's always been a weasel. He'll always be a weasel. They didn't like that. So I'm going to have to figure out how to say that he's a weasel without using the word weasel. In any case, Facebook changed its name to Meta. The first thing I thought of was basketball player, Meta World Peace. So we'll see how this goes for this guy. Do you really trust him to be the North Star for our younger folks? I don't. In fact, I hope he gets lost in the metaverse and somebody locks him in a virtual closet. So we have to come up with a word that means weasel. And anybody wants to help me with this, I need a word that means weasel. It's not weasel. So lots of earnings this week. In case you're not using it, TradingView has a fantastic earnings calendar. I use it all the time. These are the stocks I'm following in red, but it can give you everything if you want everything. But I just follow mine. Every now and then I take a look. Say, okay, I just want to see everything. Well, everything's an awfully long list. So build your watch lists. You get all kinds of different colors watch lists. And then you can go through the earnings. Pretty easy. So let's start with Alphabet Google. So they grew, which is what they do, but the growth rate for YouTube in the cloud started to flatten out a little bit. I expect that YouTube growth is probably going to flatten out longer term because there's a lot of competition out there. And unless Google decides to buy a studio, which they might, they're going to have a hard time going the complete discovery route without some production. And what I mean by that is YouTube is, all the content creators out there like me, this will be on YouTube, put out their videos and people watch them. Well, the problem is that there's not a lot of production value in everything. A lot of it's junk and it ends up being cluttered. So they've been cleaning up the platform a little bit, not as much as they should, and they probably need to add some original content. Now, interestingly, they're in a little tiff with Roku right now. So as of December 9th, YouTube and YouTube TV will no longer be on Roku for new subscribers to Roku. Although if you're an existing subscriber, you can still use it. What Google did, because they are in fact a technology company, is they started letting people watch Google TV or YouTube TV on the regular YouTube app. And I suspect that that's coming. I suspect that if you want to watch YouTube TV on the regular YouTube station, YouTube URL, you'll be able to do that real soon, pretty much across the board. And I think that's a pretty good move. And ultimately, I think that they make a move like Amazon. Amazon just bought MGM Studios. I think Google is going to buy a small studio company of some sort, something that has a little bit of a library, but really just has production capability, creative capability, and then they'll probably build it up. So I don't know if there's a Lionsgate out there that's still available or something, but I see Google going the Amazon route just to beef things up and really establish them even more as a platform that people use. And I've been talking about Roku for a few months now, ever since they had their TIF with Spectrum, and which is how I became aware of it. And I'm sure it's with other cable systems. Roku is going to have a hard time increasing margins for sure, because of all the downward pressure from the streamers. But I ultimately think Roku's just in trouble in general because they don't own the wire either. I mean, they're asking you to put hardware in your house. Well, what if AT&T and Comcast and others just say, hey, there's a built-in platform right with your cable service or your fiber service? That's what's coming. So I worry about Roku. If you own Roku, I'd really be taking profits right now because I just don't see a lot of good things in the tea leaves for them, because I think that they're getting it from all sides, Google being one of those sides. The cloud results at Google, I think, are temporary. Remember what I've told you with all the new satellite data coming in the next 3, 4, 5 years, as something like 30,000 satellite launches are planned right now, but I think it's going to end up being 50 to 100,000. The size of the cloud is going to grow 5x, at least in the next decade. So Google, with their sustainable approach to cloud service, I think are going to keep doing real well. And I will tell you, I just jumped onto the Google Cloud. I took my websites onto the Google Cloud through my web host, and my websites got faster. Imagine that. The search god makes certain websites faster if they happen to use their servers or their cloud. And I would think that any significant correction in Google, especially given all the baby Googles that are coming, I think that we probably put this at the very top of our list of the big tech companies that we want to get into. I think Google is the one, along with Apple. If we want to do something beyond QQQ or a tech fund, Apple is having supply chain issues. Well, what do we know about cell phones? We know that cell phones are replaced every 2 to 3 years by people. So a short-term supply chain issue, I don't think matters that much. I think that it just pushes things down the road a little bit and creates a bit of a demand surge at some point. So I would think that at some point in the next year to 2 years, iPhone 14, when it comes out, they'll just end up making 13 a short-termer. When the Apple iPhone 14 comes out, I think you see a huge surge. And I say that as somebody with the Apple 12. I wasn't going to buy the Apple 13. I'm not that guy. But between 2 and 3 years, my phone gets nicked up because I drop it on the ground every week, and the camera starts to work a little bit less, and I just decide, hey, I need a bigger screen because my eyes are getting older. Something, or I want a brighter screen, or I just decide, hey, carrying a camera around for photography is probably the way that I want to go for everything, versus buying $1,000 camera to take a picture of that eagle over on the mountain. As they expand their services, I think that there is an awful lot in the sustainable world that Apple is going to lead in. They have a car coming. I think their smart homes are going to keep catching on. I think new constructions are going to incorporate just a handful of platforms, and Apple's going to be one of them. Now, that doesn't mean that Apple's going to have 90% market share, but it does mean that they're going to be a significant player in a whole bunch of new forms of revenue over the next decade as buildings change, as people switch to EVs, and as more and more things become connected on the IoT. So between Apple, which has a 50% market share, Apple's about half the phones in America, and then everybody else is the other half. And of the other half, it's mostly Samsung, although I think the Google Pixel is a fantastic phone. I really think the Google Pixel is better than the Samsung phones. So I would expect that new phone that they just came out with, really, after a little stutter step, Google came out with a really good phone. The new Pixel is just outstanding. So Google and Apple are two we want to focus on. They both sit on a mile-high mountain of cash. And any pullbacks, I think Google and Apple are the two tech horses that we want. And then you come over to Facebook. Do we really have to talk too much about these guys? So there's a good article on CNBC. I want you to read it. Okay, so Facebook falls after earnings. What 5 investors are saying about the stock now. Here's the thing. fewer people are using Facebook. Fewer people are using it as often. People are using it less often. And younger people aren't really jumping on Facebook, but they're all jumping on Instagram. So I don't know to what extent that bastardizes things or just spreads things out or bifurcates things. I use both Facebook and Instagram. I got Snapchat this week just to follow my one friend group. I'll probably log into it when I'm told to log into it. Otherwise, I won't look at it. You know, there's a lot out there to use. And, oh, by the way, I got TikTok a while ago. You know, again, I look at that when I'm told to look at it. Hey, did you see this thing on TikTok? No. Well, go here. Go look at this one. Okay, it's our nephew's friend doing something, or it's it's this person that we know, whatever. Or it's this super funny thing from this thing that we heard about the one time. You know, I don't really log into any of this stuff until I'm told, hey, did you see that thing? So to the extent that I have those on my phone, you know, I think that's the way it goes. But Instagram has an interesting niche in marketing. And that is where I think Facebook can kind of keep floating along until they create this metaverse where we all end up in a dystopian reality of being stuck inside of our computer screens forever. I don't know. I don't trust Zuckerberg. I hope he gets regulated. I used to think that Instagram was going to be told to spin off, but at this point, he can say, look, I just lost 20 million subscribers on Facebook. I'm not really that strong. And I think that he's probably got a point there. I think that Zuckerberg can say, look, we're already facing pressures. We're not a monopoly anymore. And realistically, I think that's probably the case. You know, you got this Trump thing coming for social media that's probably going to be a flop, but, you know, it'll flop with 20 or 30 million users. And, you know, that's a pretty good flop. So let's just see how things go. But I'm not terribly excited about Facebook short term. I would really wish that S&P would lean on Zuckerberg to get rid of the dual share class that keeps him in control. I think that he should be subject to the same board oversight as Elon Musk should be subject to. But they get away with not, and they get super rich, and they get a little bit weird. And you have to wonder at what point do they jump the shark. And I'm not really sure if either one of them has quite done it yet. I think Zuckerberg maybe is closer or has. And we're not just quite sure about it yet. But when it comes to earnings, I think that Facebook is running into short-term headwinds. And ultimately, I actually think that Facebook is a sort of a turnaround company now. And here's what we know about turnarounds. They don't always turn around. In fact, they usually don't. So for him to talk about putting billions and billions of dollars into this metaverse thing, right, which is just virtual reality, and saying that he's not going to make money on it for 10 years, it makes you wonder if he's ever going to make money on it, because really, are people going to gravitate towards Facebook's virtual reality or somebody else's? And while Oculus is outstanding, it is easily copied. So it'll be the creative side that wins the battle in the long run. And I'm not so sure I want to bet on Facebook's creative side, because the hardware, big deal, somebody else will come out with similar hardware. In fact, that similar hardware is already out there. So at some point you have GameStop maybe says, look, you use any one of these face masks with, you know what they are. Remember those things? Somebody put in the chat what these are. I'm going to describe them. You tell me what they are. But you held them up to your face, and you put like a wheel with pictures on it, and you'd snap it, and there'd be a new picture. And then you snap it, there'd be a new picture. You snap it, there'd be a new picture. What were those things called? You know what I'm talking about? It was a toy, a little kid's toy. I can't remember. Was it called Viewmaster? I don't think it was called Viewmaster, was it? Didn't it have a more entertaining name? Oh, okay. Well, I had one of those. That is the original virtual reality. And I'm gonna say that Viewmaster was the original virtual reality, and that eventually you'll be able to use any headset to get into your metaverse of choice. your virtual reality of choice. And I don't know that Facebook's going to win that battle. So they might sink a lot of money into things, and they might not come out with anything for it. I think that they have to reinvent Facebook. I think they have to make it more eBay-like, right, on the side. I mean, they have that marketplace, but they're not making any money on it because it's all the crappy stuff. They don't have anything expensive on there. It's all junk. And they've moved. They put some things at the top of the page now. Here, this is something that's a little more upscale if you don't want the rummage sale stuff. We'll see. They have a lot of work to do. They still have a lot of users, but they have Zuckerberg. And I just don't know that he's the visionary that people want. I think he should be the chairman, and I think they should find a new CEO, and I think they need to find a CEO who people like. Maybe even they should buy GameStop. Wouldn't that be something? If they can buy GameStop and bring in the Chewy guy, Cohen, I think maybe that would be the best thing they ever did. Now all of a sudden you get a whole bunch of young people who want to be involved in this because they're not going to sell their GameStop if all of a sudden it becomes Meta and it's even more valuable, or will they? Maybe they just take their profit and they go on to the next thing. I don't really know. But Facebook, I think, has a lot to navigate, and it's not something that I put on the top of my list. It's why it's not been on the plug and play really, except for one quarter. And, that was a good quarter. It went up, whatever it went up, $70 a share or something at the time. But it won't be on the plug and play again, I think, for a long time, would be my guess. Amazon, I've told you that we might be running into peak Amazon. And now they're warning that high holiday costs could mean zero profit in the fourth quarter. At some point, and I know I've been saying this for a year, at some point, earnings and valuations matter. And I think that might matter when the Fed tapers, which is 2 weeks away. A week away, I think. I think they make the announcement late next week, right? Thursday. We'll see. Ultimately, I still think Amazon splits off the cloud services, and I want AWS when it's its own company. I really, really, really do. Because ultimately, I think Amazon just ends up being Walmart online, which is still pretty good. And Walmart, by the way, has been cutting deals with a lot of companies, Ford being one of them, for delivery services. So Walmart, which has giant buildings all over the country already, is probably going to pose a legitimate threat to Amazon in the future. And I don't know who would choose Walmart over Amazon, but it's enough people. There's plenty of people who are Sam's Club people. And Walmart really does serve 50-60% of the population pretty well. Amazon requires a credit card, so there's still, or at least some sort of credit usually. So there's still barriers there for them to expand their market much more. I think that Amazon is another company that you have to look at as two parts and decide, okay, am I willing to own the less profitable side of the business to have a shot with that cloud business? And you could say yes, but I don't think that I'm going to buy Amazon stock either. I think I'm going to stick with Google and Apple, because with Google, there's not a part of the business that concerns me. Same thing with Apple, not really anything that concerns me. But Amazon on the retail side, I wonder about that. I wonder if they can really turn that into anything other than a marginal profit business. I don't think so, right? Well, why would it be much different than anybody else in retail and logistics? There's a cap on how much they can make. It's not super scalable from the standpoint of, I can add $1 to get 10. No, every dollar they put in there, they make it $1.15 or $1.25 or $1.35, depending on what their margins end up being long term. Amazon's just not the I'm looking to get rich stock anymore. And they don't pay a dividend. So I wonder who's really going to buy that stock when it becomes apparent the retail side of that business is just a retail business. And then you have Microsoft. And in my little article here, I said, Microsoft, I expect Microsoft to keep being a beast and Alphabet to be mixed. Hey, that was spot on, wasn't it? Microsoft is still a beast. Alphabet was a little bit mixed, but I still like Alphabet on the correction. They are killing it in cloud. They're going to keep killing it in cloud. And I guess that's all I got to say about that. Microsoft is just a beast until somebody undercuts them on Office and operating systems, which companies have been trying to do forever. I guess Apple is kind of the closest one. So the third company I would add would be Microsoft. But the damn thing's never, ever cheap. And their dividend's not big enough to make me turn my head. So I don't know. If I was going to buy 3 tech stocks in order, it would be Google, Apple, Microsoft. So let's move out of the tech world. I know everybody wants to talk tech because that's really what was going on this week. But Nutrien, right? Nutrien stock rose, and their forecast was pretty good. Everything about Nutrien was pretty good. But if it's doubled for you, and I know that for a lot of you, it's roughly doubled. So we bought it pretty low. You're getting to the point where I think the easiest money on Nutrien has been made. That said, if inflation ends up being a little bit worse than I think, and if climate change has a little bit more impact on agriculture a little faster, Nutrien definitely has the ability to spike. So I don't want to put covered calls on much of my position with Nutrien, but it's had a big rally. And if you want to throw a covered call, $5 or $6 or $8 out, depending on what the price is today, I think that's okay to do. And you could even write a fairly long-term covered call. And I'll talk about that in the retirement income options article on Sunday sometime. That is one thing. I'm going to get the stocks of the week and the retirement income options out on Sunday. I'll be finishing them up on Sunday mornings as best I can. And then I think I'll probably do one more look over on Sunday nights so that I can glance at the futures, or maybe not. We'll see. Retirement income options would be more likely for that. But I'll get those out on Sundays for now on, just because I want you to be able to glance at them without the pressure of getting ready for work. And if you're retired, you can wait until Monday morning to read them. It's up to you. In any case, I think that Nutrien is ripe for a covered call on a part of your position. I mentioned that somewhere this week, so keep that in mind. The defense stocks were mixed, and I know that we've been watching Lockheed Martin very closely. We had looked at a defense ETF at one point. I'm going to review that this week because I think it's important. You know, you might just want to buy this basket. And the reason being is that these all are companies that have something to do with the space race. So I don't think there's really a lot of long-term risk here, especially if you buy them on a correction. And if we can just get the whole basket, I think that makes our life easier. But Lockheed is my favorite because I do know they have the best technology. So if they really come down to a 2016 price, which is what I've told you for years is probably the base in the market, based on earnings and the distortion from interest rates, Lockheed Martin, I think, is the one I would go with. One way to do that would be to buy the ETF that I throw out there for you that we've talked about before, which also includes a lot of small cap exposure to this space. And then you sprinkle in a little extra Lockheed Martin just to overweight that particular company. And I think that's something to keep in mind is when you buy a basket, because you want to have, say, 8 or 9 or 10% in a particular industry, you say, okay, I'm going to put 6% or 5% into the ETF or 4%, something in there. Then I'm going to add a percent or two of Lockheed Martin because that's my favorite one in the basket. That's a good way to invest. Newmont had their income come down, and remember, I'm not in Newmont right now because they are a member of the S&P 500. When the S&P 500 finally comes down, Newmont will go with it. Something to be concerned about, because we do own Barrick, is that their joint venture which Barrick is the majority owner, had a roaster that was down. Well, here's the thing, that's short term. That roaster came back online September 30th. So these gold miners took a little hit. Barrick Gold took a hit today and yesterday. I think that Barrick Gold, which we've seen the chart on, is starting to just skip sideways, skip sideways, skip sideways. I don't think they were in here this week. Nope. So if you haven't gotten into Barrick Gold yet, great time to do it. If you have room in your portfolio to sell a cash secured put on it, pretty good time to do it. Newmont, got to hold off until you get the S&P 500 correction. Remember, Barrick Gold's Canadian, not in the S&P 500. Newmont is in the S&P 500, so it'll get correlated correction whenever that correction comes. So if you really want a gold play, Barrick over Newmont right now is the point. American Tower and Crown Castle. Took a look at American Tower this week, and they're still growing, but the build out for towers is ending, and we have to do a mathematical calculation on what those cash flows are going to be worth. And I think that American Tower and Crown Castle are pretty fairly valued right now to slightly overvalued. So if there's a correction in the market and they go to slightly undervalued, that might be the best you're going to do here. The problem is that their dividends aren't all that big, and I think their major growth is done. So we have to, again, just make a mathematical calculation. How good of a dividend payer are these going to be for us in the future? And with any dividend payer, what you really are trying to do is get a discount to future cash flows. You're not getting a discount right now. You're just getting the payouts, and the payouts, not that good. So if revenues are around 10% on American Tower, revenue growth around 10%, a little lower here at Crown Castle, and we expect those revenue growths to come down in the future, but we also expect their capex to go down. We have to see what the spread becomes. Does the capex go down faster than the revenue goes down? And the answer will almost certainly be yes. So on a big correction, Crown Castle and American Tower become less of growth plays like they've been in the last several years. You can take a look at the chart, right? Crown Castle and American Tower both beat, right? So you compare. Oh, there's a way for me to pop this out for you. And you see that QQQ has beat them all over 10 years. S&P 500 is the laggard. So they've all beat the S&P 500. Crown Castle hasn't lately since really the pandemic. So for Crown Castle and American Tower, you have to look at them, I think, probably in the future, just kind of tracking the S&P 500, right? Unless you can get this on a good correction, I think we're probably done with the growth run, and this is coming off of the plug and play until that happens. On a correction, it would go back on. Same thing with Crown Castle. Talked about this in that group over here. So let's take a look at a little bit more of the secular trends. MasterCard and Visa both had quarterly gains, and they're getting into all the same things that PayPal and Square and everybody else is getting into, just from different angles. They have the established networks. However, you see that the payment volumes aren't super exciting. This isn't like 10 years ago where they're just growing and growing and growing. Their year over year change, it's been okay. And that one spike here, but not spectacular. I mean, these are single digit growth numbers when you stretch them out and average them out. Upper single digits, but it's not the growth juggernaut that it used to be. I don't know how you expect to make a lot of money on Visa and MasterCard anymore. And there's not much of a dividend to them. So I just find them to be part of the basket. And move on to Exxon. And everybody's like, look, Exxon's back. Until you realize what revenue disappoints. And why is that? Lower volumes. So they made all their money on the price increase in oil. What if price of oil goes down? It's going to. We just don't know exactly when. And again, with tapering, that'll make the dollar get stronger. Might cause the economy to just tap the brakes a little bit. Russia might produce more oil. OPEC in general might produce more oil. More and more people with the reconciliation bills, incentives for buying EVs, might buy EVs. So what do? I think that right now is probably the best time I've ever seen to sell Exxon. Because if you're paying attention to Engine 1, company that's forcing all the changes at Exxon, is they know they have to cut that dividend, and they're looking for an excuse to do it. The management that didn't cut the dividend during the coronavirus crash missed a golden opportunity because they are greedy sons of bitches. They should have cut that dividend when they got a chance. It would have been good for the company. They would have had cover to do it. And I don't think the share price would have got beat up any more than it did. So now when the price of oil comes down, they're stuck. So that's what you have to expect with Exxon. Because companies like this just keep making money and growing at ridiculous growth rates. So you know that I like PBW and TAN, and SunPower is a pretty big position for us. You know, closing in on a full position. Any correction you need to add to your clean energy investments. PBW and TAN are the easiest ways to do it. I like PBW because it moves about the same as TAN and it's more diversified. And that brings us to Ford. What do we know about Ford? So what I've been telling you for a year and a half, back when we were buying it for $5 a share, is their transition to EVs was going to be spectacular. They are converting the number one selling vehicle in America to be EV. There is no shortage of enthusiasm for that F-150 EV, for the Lightning. So much so that I've kind of been floating it by my girlfriend, who doesn't like pickup trucks. And she's probably not going to let me buy a pickup truck, but I might do it anyway. Kind of, you know, just be real quiet about it. The thing that Ford's going to come out with soon is an EV Explorer. Right? They got the Bronco as their off-roading vehicle. The Explorer doesn't need to be an off-roading vehicle. They can convert the Explorer, which used to be a big deal, and make it an EV. And I would expect that for the 2023 model year, probably. That's what it's looking like. Might be 2024, but I think 2023. So if they add an SUV that's EV, and it's in that 40-something range, it's going to be a monster success. So right now, I love my 4Runner, but for $50,000 to $60,000 to get a gasoline vehicle, with the idea that the reason you buy Toyota is that they last forever, well, I already have a 4Runner. And for a couple thousand more dollars of maintenance and repairs, I probably can keep this car to 2030 if I want to. I mean, it'll end up, you know, on the side of the house somewhere, under a lean-to maybe, just so it rusts a little bit less. But between the Mustang Mach-E and the F-150 right now, with adding 3 more plants in Kentucky and Tennessee, a coming EV Ford Explorer, right? That's a heck of a lineup. Mustangs that are basically small crossovers or mid-sized crossovers. Direct competitor to the Model Y. It's really what it is. It's another version of the Model Y, right? And it's better looking than the Model Y. We've done that comparison. And the monitor is awesome. Ford does a good job with the monitors. And the top selling car in America is going to EV. Think that through. What happens to oil demand when most of the pickup trucks are EVs? Rivian, right? Which Ford has 5% ownership of. And somebody didn't like the fact that Ford resumed their dividend, and that's a mistake. Adding the dividend gets Ford stock added to a whole bunch of ETFs, which means the price is going to go up. You need to own Ford. I don't pound the table too often. I've been pounding it for 18 months and the stock has tripled. probably going to triple again from here. And if you get a dip down to 14, 13, 12, buy some stock, sell a put. This should be a full position in your portfolio soon, if it's not already. And I know some of you, it became a double position. And ask yourself, what is your balance that you're looking for between upside and risk management? Obviously, as it becomes a bigger position in your portfolio, you have to consider risk management. But if you're truly trying to hit a home run, this might be one of the safest places to do it. Ford owns 5 businesses, including a real estate division. It's going to make buku bucks on the moving of the supply chain back to America. And nobody values that at all. You're getting their real estate for free when you buy this stock under 20 bucks a share. Maybe under 30 or 40 bucks a share. That's what the market is missing, which is the name of my new series, just to make me stand out from people on Seeking Alpha. All my articles will be titled What the Market is Missing about such and such company. Except the one that I previewed for you about AT&T, where I titled it, AT&T is the best 8.3% dividend yield of all time. And I did that to make fun of people. Really what the article is what the market is missing about AT&T. And since we're on AT&T, I'll tell you right now, if at some point you tell me you don't own AT&T, I'm going to mock you like a Frenchman from Monty Python. They divested core assets, non-core assets, made that deal with Discovery, have a massive 5G franchise that integrates with IoT, owns an irreplaceable fiber network, again, IoT, and is poised to challenge Roku, which we talked about earlier. And for the next year before the merger, you get your 7 or 8% dividend. You get a 3 or 4% dividend after, the divestiture. But you also get a big hunk of Discovery, which might end up going on a Netflix-like run. So buy AT&T if you don't have it. It is my only double position. I'm 8%-ish in AT&T. I'm A-okay with that. Because there's hardly any downside at this point. A couple bucks maybe. So what do we know about inflation? Everybody wants to talk about inflation. Oh, by the way, Caterpillar supply chain issues. They said it too. Employment costs rise at record pace as wages surge. That's good, right? We should all love that. We should all love that our wages are going up. But for companies who are underpaying people and using that to pump up their earnings are going to take a little hit. And it's especially going to hurt the worst companies, right? Your better companies will get over it. They just might have a hiccup. But your zombie companies, what are they going to do if they have higher labor costs and they were already borrowing money because they have low growth? The zombie hunting is coming. And we should think about what is transitory inflation, because that is what we have. It is transitory inflation. And in this article, which you can get on Bloomberg, John Authors, who's a pretty smart guy, talks about the signs of inflation. And they're basically there. However, we should really ask, what does it mean? When will prices come down? And that is what people don't understand. Transitory inflation doesn't mean that inflation will suddenly disappear at some point. It just means that the inflationary pressures will come down. It'll just be tied to money creation at that point, which has always been around 2% growth until we entered the QE age when we were like, let's bail out everything. And the bailouts were probably right. Did you really want to sit through a 30 or 40 or 50-year depression because of the way demographics work? No, we're doing this right by printing money, because the deflationary offset of demographics and technology offset the fact that we're printing money. It's just a mathematical equation. So all these hyperinflation idiots, because hyperinflation, when I was in economics, we were taught that's a triple-digit inflation rate for a year. Other things I've seen on the internet lately, which means it's right because it's on the internet, is 25% a month or something. Whatever. It's way more than 3 or 4 or 5%, which is where we're at. The thing is, prices will not come down. Just because inflation stops, it gets back to normal, which it will soon, doesn't mean the prices will come back down. They won't. Those higher price levels are sticky. So think of it like a staircase. We were walking level, and then we hit a staircase. We're going to go up a few steps, and now we're going to be on a new floor. That's the way to think of what inflation is. So we've been on this relatively level plane for 30 plus years, very minor inflation, very low single-digit rate inflation. Now we're going up, and we're just going to be on a new floor. That devalues the debt. That allows us to fund a whole bunch of things. And when you take a look at the Democratic reconciliation bill, what do you see? Do you see a whole bunch of deficit spending? If you say yes, you're wrong. The Democratic bill is basically balanced. In fact, preliminary estimates is that it brings in more revenue than what they create in spending. A lot like under that Clinton guy. So when people come around and say, oh, the Democrats are spending. Look, I've worked for Democrats, I've worked for Republicans. And all I can say is when people start getting partisan like that from the standpoint of making accusations that they don't understand, that's not really how it works. The Republicans haven't paid for any of their tax cuts. The tax cuts the Republicans have given that helped billionaires become 70% richer in the last year and a half have never ever paid for themselves. Definitively, we know that over 40 years. Tax cuts for the rich have never, ever paid for themselves, ever. So when the Democrats come out and try to say, look, we should have, right, 3K and 4K, a little bit more childcare, a little bit more education, and have subsidies in the short term to help clean energy catch up, which that's one way to do it. I just think we should get rid of all energy subsidies because clean energy would crush fossil fuels at that point, because fossil fuels have huge subsidies. But it has to do with energy security, so you give them a leg up on the entire economy. So you give all energy a leg up on the entire economy. And that keeps energy costs low. Why is keeping energy costs low important? Here you go. This one's real easy to see. Inflation around 5%, but in energy, it's over 20%. As energy inflation comes down, what do we know? All these other inflations will come down as well, because energy impacts the price of everything. So as energy gets cheaper, and it's at a higher point right now, not the high point, who knows, but a higher area right now, as it comes back down to equilibrium, and remember the price of oil historically has been way lower historically than it is now. I mean, 40 something a barrel has always been kind of normal. So what if the price of oil comes down to 40 or 50 something dollars a barrel? I think that would be the low end, absent some shock. But let's say we're near the high end and we have to get near the low end. I think that that's where we're at. We're near the high end for oil. We have to go back to near the low end, or at least in the middle. That'll bring this way down because the year over year comp, right? The price of oil stays the same. This drops down to zero, right? Because it didn't change. And everybody else adjusts. And then their inflation rates go down too. Then what if the price of oil actually falls? That's disinflationary. And you could actually get deflation. I don't think that's going to happen, but it could. Because the demographics are on the side of deflation, and Oscar is right, deflation is the boogeyman. Another article I'm writing is called Inflation is the Trade, Deflation is Forever. And I'm going to have to put into the article that forever, for all intents and purposes, just means the rest of our lifetime. Anybody who is living today is going to face deflationary pressures for the rest of their life because the population isn't growing the way it used to. There's not as many young people coming into the system, and the old people are living longer, and they're spending less, and they're trying to stretch out their money. And I'm actually a fairly big believer in spend your money in retirement as fast as you can. If you can spend your last dollar at your last breath, you did it right. And of course, nobody does unless they go broke on accident, because we all want a cushion just in case we might live another day. As energy prices come down, inflation is going to disappear. Probably by the first quarter of 2023, you'll have an inflation rate below 2% again. It's only 18 months away, 15 months away. So we are much closer to the end of the inflation trade, which started with the last huge round of QE. So a year, 6 months ago, 4 months ago, whatever it was. We're way closer to the end than the beginning, because the end really starts at the middle. It's pretty much too late to get into most of the inflation trades. Take a look at the charts that are out there. If you're chasing oil, if you're chasing copper, if you're chasing a lot of these things right now, you're just a chaser. FOMO, FOMO, FOMO. And you're hoping that there's another puff on the cigar. And if you're going to try to play that game, you better be an outstanding trader, because those aren't investments. Inflation is going to come down when energy prices come down. And in fact, energy prices will come down probably faster than you expect. So I think that you're going to hear some things from Russia and OPEC that you didn't expect. And if you don't hear those things, I categorically guarantee that at some point Joe Biden opens the Strategic Petroleum Reserve. Maybe just temporarily to not get crushed in the midterms. But remember, there's a huge sale of Strategic Petroleum Reserves happening right now. It's coming. It's already coming. It was pre-planned. I forget how much it was, but it's a pretty big number. But what if they double or triple or quadruple that number? So you better be a spectacular trader like Shooter, who keeps up on this stuff by the hour, if you're going to try to trade energy to the upside. Because all the fundamental things that I've lined up, they'll happen eventually. And you don't want to be the bag holder when oil opens limit down, because it's going to. And every time that I say something like that, people go, ah, and then every time it happens. So you always have to decide, are you an investor or are you a trader? And if you're a trader, you better be on fundamental trends in that chat room every day with Shooter, because he's in there 3 or 4 times. If you're an investor, I'm telling you, when these corrections come, buy alternative energy, buy technology. And those 2 things should be a majority of your portfolio, over half. Remember, technology is almost half of the economy. So why wouldn't it be around half of your portfolio? Wow. Just hit you with some logic there, didn't I? If technology is about half of the economy, why wouldn't it be about half of your portfolio? And then throw clean energy on top. All right, let me pause, and then we'll jump into some question and answer. I am hulking today, so we'll do a pretty short Q&A. Hold on 2 seconds, please.